Centuria is a boutique listed fund manager managing $2 billion on behalf of our investors across three areas: listed property, unlisted property, and investment bonds. We've been doing this for over 35 years and manage money on behalf of 83,000 investors. Investment bonds are a tax-paid structure where investors can invest their money and Centuria, or the investment bond provider, pays the tax at the company tax rate on behalf of the investor. The investor does not need to include their investment as part of their tax return, and after the investment has been held for 10 years, they can make withdrawals without including those withdrawals from the fund in their tax return. Investment bonds have been around for over 35 years, and they're really a tried and tested structure for investors, now with a series of contemporary investment options sitting beneath them. Investment bonds are really suitable for investors across the whole investment life cycle. So if someone's starting out as an investor and has a young family, investment bonds are a great vehicle to help them save for their education. If someone is wanting to accumulate wealth outside of superannuation or supplement their superannuation, an investment bond's a great vehicle to be able to do that, particularly anyone who's earning or paying tax above 30%. And then for those in their later years, using an investment bond, because it's an insurance product, you're able to nominate a beneficiary, and that means that the investment sits outside the will and passes straight to the beneficiary on death or proof of death. And the final area where investment bonds can be really helpful is in the retirement or aged care space, where there are certain social security advantages for holding an investment bond. The investment objective of the Centuria Growth Bond Fund is to provide investors with exposure to growth assets over a 7 to 10 year period, predominantly focused on Australian and international shares. The Growth Bond Fund can invest in a range of assets. These include Australian and international shares, fixed interests, property, and cash. The focus clearly is around growth, and therefore the fund will invest in Australian and international shares and property to provide growth to our investment bond holders. So we have a three-stage process at Centuria around how we select and review our managers. First, we look at managers who have a track record over 1, 3 and 5 years, who manage less than $500 million in FUM and have performed in the top quartile over 1, 3 and 5 years. We then look at the manager capability and the depth of management in that fund, and we do that through management interviews and secondary research. And the third area we look at is the qualitative research that sits around both their Morningstar reviews and their Lonsec reviews. And from that, we then make a recommendation to our investment committee around selecting or reviewing that particular manager. So we have an investment process where we review our managers on a monthly basis. And if there are changes in either the management of the fund or a change in how an external research house would look at that fund, we may look to either place that manager on watch and observe how that fund is being managed. If the fund's being managed well, we'll maintain the manager. But if there is some significant change as a result of either management or strategy of the fund, we'll then place that fund on watch and undertake a more significant review. And that process at times can take somewhere between either a month or 6 months. So the investment bond provider, like Centuria, is paying the tax in the fund on behalf of the investor over the duration of the bond. And so what this means is that the investor doesn't need to include their investment in the investment bond in their annual tax return. They don't need to supply their tax file number to us or to any investment bond provider. And the only reason they may need to pay tax is that they may withdraw their funds prior to the 10-year term of the investment bond. So there are two things that may trigger the maturity of an investment bond. The first one is the 10-year period, and so after 10 years, any withdrawals made out of the bond are tax paid, and the investor doesn't need to include those withdrawals in their tax return. The second one is if there is a death of the bond owner or the life insured of the investment bond, and that triggers the bond to be extinguished, and the proceeds of the bond are paid to the beneficiaries of the bond, tax paid. And so there is no tax declaration either in the estate of the beneficiaries or the individual beneficiary should the bondholder pass away. The other area is if there are withdrawals out of the bond prior to the 10th anniversary of the investment bond, and if withdrawals are made then, tax is calculated at 2/3 of the investor's marginal tax rate in the 9th year and at 1/3 of the investor's marginal tax rate in the 10th year. All the income that's generated by the investments held within the investment bond stay within the investment bond structure, and that income is reflected in the unit price or the value of the units that are held within that structure. And so the value of the bond is reflected, including both the income and the growth component of the fund. Investment bonds are a great tool for estate planning. These days, many grandparents love their grandchildren more than their own children, and they want to transfer their wealth from themselves straight to their grandchildren. And a great way to do that is to utilise an investment bond, and that is, investing in their names and nominating their grandchildren as beneficiaries. If an investor does that, on death, the funds transfer directly to those beneficiaries tax-free or tax paid, with merely just the proof of death required to have those funds paid. So those funds sit outside the estate and sit outside the will when a beneficiary is nominated.